For roughly a century, the international financial system has been anchored by a single core assumption. The United States dollar is the ultimate safe haven. Global central banks, the most conservative institutions on Earth, have historically parked their wealth in U.S. Treasury debt, treating these government bonds as the absolute bedrock of a risk-free portfolio. But that bedrock is shifting. In a report published in June 2026, the European Central Bank officially acknowledged a significant reallocation of global wealth occurring within these institutional reserves. This chart illustrates the breakdown of global central bank reserves. Look at the trajectories for gold and U.S. government debt. At the end of 2023, gold sat at 16% of reserves, while U.S. Treasuries held 26%. By the end of 2025, these assets essentially swapped positions. Gold rose to represent 27% of reserves, while U.S. Treasuries fell to 22%. Pay close attention to the exact moment these two lines cross. Central banks are price-insensitive buyers who purchase assets to maintain macroeconomic stability and keep inflation low. They are now choosing to replace fiat government bonds with a physical heavy metal. This raises a difficult question. Why are diverse global institutions, ranging from historic adversaries to pro-U.S. NATO allies, suddenly moving away from U.S. Treasuries to hoard physical gold? The data suggests a steady erosion of global dollar dominance is underway, forcing an audit of the specific geopolitical and economic risks driving this shift. The primary catalyst is geopolitics. In 2022, the United States and the European Union seized $300 billion in reserves belonging to the Central Bank of Russia. This action removed the assumption of neutrality for the Global South. It demonstrated that keeping reserves in the U.S. financial system is conditional. If a nation's policy conflicts with Western interests, its sovereign wealth can be frozen or seized. Russia was the largest target, but it followed an established pattern of Western asset seizures that previously targeted nations like Iran, Libya, and Venezuela. In response, nations in the BRICS economic bloc have accelerated physical gold purchases. By trading in local currencies and stockpiling gold, they are attempting to build a financial defense mechanism that operates outside the reach of unilateral sanctions. This anxiety extends to Western allies as well. Poland, a member of NATO, has become an aggressive purchaser of gold. The ECB report notes that central banks increasingly identify geopolitical risk as a primary threat to their reserve environment. By utilizing the dollar system to punish geopolitical rivals, Western powers have incentivized the rest of the globe to seek alternative financial ecosystems. Beyond politics, central banks are reacting to an economic strategy known as the debasement trade, fueled by rising U.S. government debt and persistent inflation. There is a growing fear that the U.S. currency will lose its intrinsic purchasing power over time. As debt levels rise, the dollar's value is perceived to be at risk of long-term dilution. The People's Bank of China has been a dominant institutional buyer in this environment. Between 2015 and 2024, they purchased more official gold than any other country, and some analysts suggest their true unreported reserves are significantly higher than official figures. Gold provides essential market utility for nations facing sudden inflationary pressures. This is often seen during global energy crises, when the cost of oil imports puts downward pressure on local currencies. Take Turkey as a case study. When oil prices skyrocket, the cost of imports causes the lira to depreciate. Turkey's central bank has sold portions of its gold reserves to buy its own currency on the market, successfully stabilizing its value. These strategic sell-offs demonstrate that gold is functioning as a reliable macroeconomic stabilizer, a liquid asset that maintains its value when fiat currencies struggle. It is important to distinguish this shift from sensationalist claims of an overnight dollar collapse. The current data does not suggest the dollar will become worthless tomorrow. Instead, it shows a methodical transition in global reserves. The International Monetary Fund describes this process as a stealth erosion of global U.S. dollar dominance, a gradual decline that has been occurring for decades. This chart visualizes that erosion. In the year 2000, U.S. dollar assets made up over 70% of global foreign exchange reserves. By 2023, that share fell to roughly 55%. We are moving toward a multipolar monetary system. In this environment, the U.S. dollar remains important but no longer holds a monopoly. sharing the stage with the euro, the yuan, and physical gold. The historic rally in the gold market reflects a long-term adjustment in how nations secure their wealth. It is a physical reaction to a changing international environment. The intersection of gold and U.S. Treasuries on the central bank ledger indicates that economics and geopolitics are inextricably linked. This data signals a quiet but undeniable transition toward a more fragmented financial reality.